engineered. Nature-based does what it says in the tin. These projects are linked to natural projects that would remove carbon from the atmosphere anyway, but they are often helped by and implemented by developers and local operators on the ground. These are often some of the obvious projects that people will think of if you think about a carbon project. Things like afforestation and reforestation, so planting trees on land where either had no trees there or used to be forest land. You can also there's a lot of projects, especially in Southeast Asia, that focus on restoration of mangrove projects, mangrove trees along coastlines. So nature-based is all focused on the natural world. Engineered solutions are much more mechanical in nature. They derive, and there's a number of different types of engineered solutions. They are increasingly popular. They range, as I say, a number of different types, but some of the most popular ones at the moment, things like direct air capture. These are, in a simplified way, they are giant fans that suck in air, and they split out the carbon from the air, and actually they mineralize it and pump it down on the ground, and it's stored there for thousands of years. So they often represent a very permanent type of carbon sequestration, carbon removal, and they are increasingly popular, but due to the costs involved in implementing these projects, they often come at a much higher price if you want to buy carbon credits from an engineered solution like direct air capture, for example. Across both types of nature-based or engineered, you then have another subsection of carbon projects, which can either be an avoidance project or a removal project. Carbon removal projects will remove 1 ton of carbon from the atmosphere, whether it be through direct air capture or indeed through planting of new trees that will sequester carbon throughout their lifetime. Carbon avoidance projects don't necessarily remove carbon from the atmosphere, but they avoid further emissions going into the atmosphere. One good example of a carbon avoidance project would be protecting existing forestry, land that had that might have been deforested, and trees might have been chopped down to implement grazing land, perhaps, or new farming pastures. Protecting that existing forestry is one of the most popular forms at the moment of avoidance credits. Typically, you see pricing differentials between the avoidance and the removals. People, in some cases, will look at these two and state that carbon removal projects and carbon removal credits are higher quality because they actually remove the carbon from the atmosphere rather than simply avoiding additional emissions. And this fourth category here is more a Kita category, really. This is the two main types of businesses we are seeing who are interacting with the carbon markets, the voluntary carbon markets specifically. We split them out into two main categories. One being businesses that are interacting with the carbon markets as part of their own net zero strategies. These can often be general corporates across various types of business lines, but perhaps they have a 2030 carbon neutrality strategy, and as part of that, they are investing in carbon projects and purchasing carbon credits for their own use within the company. The other category of clients we're seeing are those that treat or are viewing carbon credits more as a new asset class. These are people that are potentially looking at carbon credits as a tradable instrument, something that might increase in value over time, and so people are investing in projects today to gain access to supply to these credits, either for further on sale or for whatever purposes they may have. Those are some of the two main client types that we see here at Kita. this is a little bit of an overview about who, what, where, why, and how we're doing this at Kita. As I said earlier, removing carbon from the atmosphere is required and is very much a key aspect of the fight against climate change, and we are here to support those who would like to engage in the carbon markets a little bit more often. We've spoken to a number of corporates that have interest in doing so, but perhaps they don't necessarily have the internal confidence to do so. They don't have the internal sign-off to do so in some cases. And insurance will often bring about the traditional risk transfer and all the risk mitigation. We would like to apply that to the carbon markets and help get more people interacting with the carbon markets. That being said, there are obviously risks involved in carbon projects and both in the compliance markets, but also the voluntary carbon markets. What we've tried to do here is split out and evidence the two of the main categories of risks that we see. Risks to the physical assets. These are risks that are pervasive across all types of carbon projects, whether it be nature-based, whether it be engineered, whether an avoidance project or indeed a removal project. These are risks that could destroy the asset or result in it not performing as it should do. Any nature-based solution is often heavily exposed to natural catastrophe risks. A lot of afforestation projects, for example, they will require the right level of rain. They will require the right climate for the trees to grow as predicted. And there's many things there that can result in an underperformance or a complete destruction to the project. But equally, on the more engineered side, there are plenty of risks to that physical asset, many of which might be slightly more common, especially from an insurance perspective. It might be supply chain risks, it might be operational machinery risks. So we're seeing a lot more interest and a lot of engagement from some of the traditional insurance markets for property, physical damage, energy markets that are used to some of these machinery risks and risks to the physical assets. They're often looking at these now, but with a lens focusing on some of these more engineered carbon solutions. Within the intangible asset side as well, there are plenty of things that can result in a project not performing as it should do from an intangible risk side. Throughout the process to perform a carbon project and in turn generate carbon credits, there is an independent audit process throughout. There are pre-approved standards by which carbon projects must operate their project, and there are also pre-approved bodies who will come in and audit those projects and periodically assess the performance of them, and those are often the reports and the audits that will issue carbon credits as a result of them. Throughout that process, there are risks, obviously. The risks perhaps to the delay of this issuing and this audit process, but indeed there are risks that the project hadn't necessarily factored in various risks and various forecasts, estimations, assumptions, and perhaps they got their models wrong. So there are a number of things from an intangible perspective that can lead to underperformance of a project. In the next slide here, we go through and sort of run through some of the risks and how we see them interlinking with a carbon project throughout its lifetime. And we at Kita try and provide insurance for some of these. In due course, we would like to provide insurance for all of these, but it's a process to get to that point. So we started on this diagram at the very beginning on the left. You see the concept stage, and this is a point when a project is potentially going through its feasibility report. It's ascertaining whether a project can take off and can be implemented, all the way through to the sort of issuance on the right, where a project generates its carbon credits and can indeed sell them. And there's a number of different risks that can affect this project throughout that period. The non-delivery of the carbon credits, and so essentially the performance of the project, that is the core risk that Keta's flagship product focuses on. It is looking to protect investors or indeed purchasers who have prepaid for a carbon credit and don't get those carbon credits. Typically, especially with the nature-based world, these projects take some time. Simply putting it, trees take some time to grow. So quite often there will be a cash disbursement or some capital expenditure on day one. And as an investor, as a purchaser, you might not get those credits for 5 years, perhaps. That 5-year window, you as the investor would be taking on delivery risk, and you're taking on the risk that the project is not able to deliver the credits it is supposed to. And that indeed is what our core carbon purchase protection cover is designed to insure you against and insure you for. But there's also a degree of pricing risk, and this is something that we see increasing over time. Price is generally expected to trend upwards, and we see, speaking to a number of different clients, we see this being a big driver behind investments today, because people expect prices to increase over time. So people are investing today to make the most of today's prices, and to secure the supply at today's prices, or perhaps even at a discount, as a result of the prepayment that's being made. But as price increases, obviously there will be some pricing risk and market risk to that degree. There's a reversal risk as well that all carbon projects in the voluntary carbon markets will face. This is the risk that carbon has been removed from the atmosphere, but then something happens to the project that reverses that process, and carbon is released back into the atmosphere. In the nature-based world, that might be the forest burning down, and in that scenario, obviously the carbon that was stored within the trees would be released back into the atmosphere. This is at its height once the carbon has been removed from the atmosphere, of course, and there are insurance products out there that look to cater towards that reversal risk and to try and ensure that the carbon has been stored permanently, and in the event of a reversal risk, perhaps there are ways to provide a claim that can be reinvested in replacement carbon credits or something to that effect. One of the other major risks that we see in this chart again is the counterparty risk, and this is something that is again prevalent throughout all types of carbon projects. It's essentially the risk that the project developer, from a business perspective, is able to do what they commit to doing, whether that be through their expertise and their understanding of the project and their ability to perform the project, but also from their financial profile, and are they financially able to perform the project and generate the cash that they need to stay afloat and to manage the project correctly. With that in mind, that there are many project developers that are smaller and local entities on the ground in the countries where the projects are being operated, and so in some cases these don't necessarily, from a financial profile, look as strong as you might choose, and so again that's one of the reasons why insurance is helpful to get people more comfortable investing in these projects and providing the down payment and the prepayment to these project developers so that they can operate their project, but with a degree of risk protection there as well, from the insurance. Invalidation is another risk here. Again, it's a little bit like the reversal risk, and it's focusing on the risks that something occurs within the project that invalidates the credit. So as a buyer, you might have bought your credit and you carbon credit, and you think that it is and that you're fine, and that's great. But there have been certain instances, perhaps, where actions by the developer have resulted in the project being deemed lower quality, and some of the credits might be invalidated after the fact and after you purchase them. Again, there are insurance products out there that can cater to this and can provide protection here. And that's something that, again, Keto is keen to expand into in due course. And there are other insurance offerings out there that do this at the moment. So that's which is quite helpful. And the final risk that we have highlighted here is political risk. This is something that is very much a risk in a number of countries where these projects are often located. And this might be some of the traditional political risks, things like confiscation of assets, government expropriation, or selective legislation put in place to impact specific companies. But equally, within the carbon markets, there are a number of specific carbon market political risks that revolve around how that host country is interacting with their own carbon markets, but also international carbon markets. And governments and countries will impose nationally determined contributions, which is essentially a countrywide net zero strategy. And there are perceived risks that governments might expropriate carbon credits to use them for their own purposes, rather than necessarily allowing them to be traded internationally and used by other countries or other corporates. And that is a specific insurance product, actually, that we at Keto launched last year now, and then last summer, focusing on the political risks and the risks around government expropriation and any legislation that government might implement that would reduce the value of an investment that has been made. I'm going to run through here a little bit of an overview of our core delivery risk insurance product and how that one works in a little bit more detail. As I said earlier, this is essentially looking to ensure the performance of a carbon project. So we typically see quite a lot, and increasingly so, entities are forward purchasing carbon credits. They are investing today to secure the future supply. As I said, especially in the nature-based solutions, but also in engineered, there's often quite a long time period before the carbon credits are issued and can be delivered. And so there is a risk in that period that something happens to the project, and therefore you would not receive the promised quantity of carbon credits. And that is where our insurance fits in. So in its simple form, a client might invest $2 million into a project and expect to receive 100,000 carbon credits in 3 years' time. Our insurance protects the client against the risk that they don't receive that quantity of credits. And that could be because the trees didn't grow as quickly as they were expected. So when the audit happened, perhaps came in and they hadn't grown as expected, and therefore less carbon was removed from the atmosphere. That would result in fewer carbon credits being issued, and therefore fewer carbon credits being delivered. That is something we would cover. Equally, it could result from a complete wipeout of the project. Drought destroyed the entire forest, or wildfire burned through the forest. Perhaps some of those reasons, but equally it covers the counterparty risks. Perhaps that the project developer themselves went insolvent during that period, and you didn't receive your carbon credits as a result of that. So all these All these risks are bundled up within our delivery risk insurance. It looks and feels a little bit like credit insurance for those of you who might be familiar with that. It sits behind that purchase contract and it is designed as an all risks cover. The only major exclusion we have has been the political risks, and that was because we wanted to specifically focus with that, focus on that with a set aside and specific insurance policy. Running through some of the things that we will look at when we are assessing these projects and these risks. We've highlighted 4 things here, but in reality there are many other aspects that we would look at. These are perhaps some of the main bits we will focus on. We would look at the carbon buyer and the investor who would be our insured, our policyholder. This is often something that we are keen to work with. We would like to make sure that clients have done their own due diligence and they are aware of what type of carbon projects they're purchasing, perhaps, and it's always good to understand their incentives and make sure that we perhaps can help them, or indeed that they are purchasing carbon credits for the right reasons and all of that. So that is the first step we would really undertake when we're discussing with clients and looking at a specific transaction. We then would do a deep review of the specific project in question, whether it would be a forestation project perhaps, or a direct air capture and the engineered solutions. We would want to have an understanding of that project, its technical elements, its expectations and assumptions, what its forecasts are. That would allow us to really dive into the risks specific to that project, and anything in that project, in that region, in that country that might impact that project's ability to deliver the predetermined quantity of credits. As part of that, we would review the project developer, both to understand their expertise and their experience managing projects that are similar to this perhaps, or indeed managing other projects within the carbon markets. But also we would do a deep review of their financial statements, because covering their insolvency requires us to have a detailed review of those financials and to make assumptions and expectations based on their ongoing financial health. That's a key consideration as part of our underwriting. And then one of the other key bits here is the carbon contract. So understanding this transaction structure, understanding the contract, and any risk mitigations that might be built into the contract. Increasingly so, we are seeing structures and transactions that are getting more and more complex. We're seeing banks getting a little bit more involved in the carbon space, and we're seeing financing entities and funds getting more involved as well. And with those, we're seeing the complexity of the contractual structures increasing. So we're keen to review all of those contracts and make sure that they are, or have a good understanding of what is included within those, both so that we might be protected as an insurer, but also so our clients have a good contract and would be protected from their perspective as well. I'll finish up here from my side. The report here, Gross Written Carbon, is just something I thought worth highlighting. We wrote this in conjunction with Oxbow Partners at the end of last year, end of 2023, I believe. And this outlines the potential opportunities for the insurance market within the carbon markets. And the tagline Gross Written Carbon is a nice play and trying to link the positive outcomes that the carbon markets can try and bring in the fight against climate change, but also the opportunities to the insurance market and all the different opportunities insurance and different types of insurance that might be applicable to the carbon space. So thank you all very much for listening. I know Perry was going to ask and see if there's any questions. I'm not sure if there's any in the Q&A section just yet. could you share with us this presentation's PDF?
Yeah.
Yeah, I'm sure.
Yeah,
Sorry,
thank you,
John.
Alek. There is one question asking about your slides. Can it be shared with the participants after the session?
Yeah, sure. We'll be able
Okay.
to share a version of these.
Okay, thank you. And now we have some questions coming in. Okay, the first two questions I see here, I think I've answered. Presentation slides will be shared after that. Basically, a question from Rebecca Rowan. Have you seen any claims as yet? Yeah. So, and the next question is, do you work with brokers or directly with the insurance? So can you take the first question? Have you seen any claims as yet? Yeah.
Yeah, absolutely. Short answer is no. Touch wood. We've seen no claims just yet. The nature of our policies and the transactions we work on, they're often long term, and so the risks we've been covering are often 3 years, 5 years in length. So most likely we would see, if there were to be claims, we would most likely see those in years to come. It would be quite nice to have a small claim to run through as an example, as a sort of a process to help work through that and understand how it would work. But as of today, we've had no claims. I see the next question there is on whether we work with brokers or directly with the insureds. We at Kita have the ability in some jurisdictions to do both, but we also have a strong preference working with brokers. We spent a lot of the last couple of years meeting brokers and trying to explain in some cases how our insurance product works, because it is somewhat novel and it is different to other insurance products out there. But we've seen, and it's been a really positive experience. We're seeing really good traction with insurance brokers across different types of insurance in different markets, which is great. Starting to see some deals coming through from them, which is really promising and really exciting. But we also do work directly with some insurers. What we often say is that it is where we have the licensing and the regulatory approval to do so. We will work with the client and follow their preferences. But we have the ability to do both.
Okay. The next one from Rahadi Pradana. Who currently makes up the majority of your clients? Is it financial institutions, carbon emitters, or government?
That's a good question. We have a real range of our client base at the moment. Some of our main clients to date have been corporates across a range of different industries. Some in the automotive industry, some in more general commodity industries, and they're purchasing carbon credits for their own use. We are starting to see financial institutions getting more involved, and we're speaking to a number of financial institutions, banking institutions, and otherwise. But they're slightly newer from what we're seeing. They're slightly newer to the carbon markets, and the existence of insurance has actually been, from what we are hearing from our clients, for banks especially, having insurance has been a very key part of their internal discussions and internal agreement to engage with the carbon markets. So I think that's one that we're very excited about, and one we suspect will become more and more the case going forward. So the financial institutions will get more active in the carbon space.
Okay, thank you so much. Next is from Oliver Clark. Will insurance replace the current buffer system or work alongside it?
Yeah, that's a very good question. We are not designed, our core product at least is not designed to replace the buffers. These buffers pools are used by the carbon standards that sort of outline the methodologies for each carbon project. They're used to set aside credits in a predetermined buffer against some of those reversal risks that I touched upon earlier. So it's almost like an insurance policy, self-insuring at the carbon standard level. we see our insurance sitting alongside those. So they work in tandem together rather than our insurance replacing the buffer. We do actually have a very niche insurance product that sits behind the buffer pools themselves and reinsures them almost. And we've had nice traction on that one last year with some of the carbon standards, so that's quite exciting as well.
Okay, thank you. I gather that the next question comes from Egypt. I'm working in a regulatory organization from Naira Ismail. What is your recommendations for the first steps that we can take to involve insurance companies? Where's the question gone to? Sorry. Yeah, to involve our insurance companies in our VCM here in Egypt. Yes.
I think really the first step is to have the initial conversations. We're seeing a lot of insurance companies that are interested in this space and keen to understand more and learn more. But there's often a bit of an educational barrier to entry that people and insurers almost need to get more comfortable in their understanding of the carbon markets before they will be willing to support transactions. There's plenty of reading material out there, and there are plenty of really good webinars and articles that can help inform and help build that knowledge and expertise. So I think that would be the key starting point at the very beginning. And then seeing what else is out there as well. There are Kita has a number of insurance products and services, but there are other insurers as well. Some of our peers who have different insurance products that all cater towards the carbon market. So I would always suggest seeing what else is out there and getting an understanding of that and how that might then apply to a market like Egypt, for example.
Okay, thank you. Next question. Would insurers like yours already support or will support claims if the corporate has retired the credits and there's a previously unknown or hidden risk exposed, like land rights for an ARR project?
Again, a very, very good question. We see that really is depending on which type of insurance product you might have purchased. For example, our core delivery risk product, that focuses on the delivery, and so once those credits have been delivered, we would deem that policy as off risk and as having expired. So that policy wouldn't necessarily consider a claim if the corporate has received the credits and retired them. But some of the other insurance products we're working on, like reversal risk or invalidation risk, those are very much intended to support clients who might have purchased credits, retired them, and then, like suggested here, a land rights issue, something is discovered that renders those previously retired credits invalid. That's the exact sort of scenario invalidation cover would look to support.
Okay, thank you. Next question. How does the carbon insurance market works? For example, X company purchases carbon credits from Y, and X also does insurance of it with Kita. Then on non-delivery by X, Kita comes and pays the non-delivery, the insurance. Is that correct?
Yeah, so we would work with the entity that is purchasing the credits, or indeed investing in the project. So if a company had purchased credits and was expecting delivery from the project, we could insure that purchaser. And in the event that they don't receive the credits, we would provide them with a claim paid in cash, or indeed paid in replacement carbon credits, because we have the ability to pay our insurance claims in carbon credits, which is quite a nice feature that we expanded into last year. So we would, and that at the point of non-delivery, we would work with our purchaser client and either provide them with a cash payment or indeed a carbon credit payment, so that they got their money back, all the credits that they were expecting to receive.
Okay, and the next question is interesting. We're talking about life insurance. So what will be the impact to a life insurer?
Well, I suppose there's a number of different impacts that a life insurance company could see. We've seen, in some instances, life insurance companies purchasing carbon credits themselves, because they will have their own emissions and they will have their own net zero strategies perhaps. This is one of the interesting things about the carbon markets, is that every type of company can engage with the carbon markets, whether it be commodity trader through to someone like a life insurance company. So we've spoken to people like life insurance companies who could be a client of ours because they are purchasing carbon credits. Equally, we're seeing in some cases life insurance companies providing some of the capital to invest into these projects through funds or through other financial vehicles. So there's a number of different ways life insurance companies and many other insurance companies might interact with the carbon markets, and all quite exciting.
Okay, thank you. Next question comes from Uttam. Hi, Uttam. What sort of premiums are expected to be generated over the next 3 years for carbon insurance?
So we say in our report that potentially over the next 10 years, premiums could reach a sort of $5-10 billion. By 2050 they could reach $10 billion in insurance premiums. We think that's quite a nice incentive. Over the next few years, I suspect it won't be the $10 billion number just yet, but we're certainly seeing a very steady growth in the premiums that we have built in the last year or two since we started our first insurance product. As more insurers come into this space as well, then there's only going to be growth as a market for the total insurance premium. I'd hesitate to put an exact number on it, but it's got some exciting growth potential for sure.
Okay, I like the next question from Rahadi Pradana. What do you believe is the impact of US exiting the Paris Agreement recently to the carbon market?
Yes, that's another very good question, and it's not the first time someone's asked me this. Actually, I had the exact same question yesterday. I think that it wasn't necessarily a major surprise that happened. I think as a result of that, much of the carbon market had sort of prepared for it. So because it didn't come as a surprise, that hopefully the effect will be limited. But we know of a number of projects within the United States that have already begun, and we don't expect a major impact on their performance, perhaps. But what it might mean is that just there is fewer projects going forwards that are launched and get off the ground within the US, at least in the short term.
Okay. Next question. How do you ensure replace credits meets clients' requirements?
Yeah, so again, that's another very good question. There is, within all these types of carbon credits, as this question alludes to, whether it be avoidance, whether it be removal, whether it be nature-based or engineered, that each company or most companies have some sort of preference. They might also have geographical preferences as well. So before binding any insurance where we would be paying a claim in replacement carbon credits, we would work very closely with a specific client to understand their preferences, understand their requirements, and build that into the process we have when we would look to go and source replacements. So if it is a strict requirement that the project must be nature-based, for example, then we can work that in, and we can make sure any replacements we source would be nature-based. We ultimately as well, whilst we offer the ability to pay claims in replacement carbon credits, even if it gets to that point, if that specific client isn't, or would rather not receive the replacements that we suggest, the backup option is always to receive a cash settlement for that insurance claim. There's no requirement that they have to take the proposed replacement credits.
Okay, thank you. Next question. Do you already have clients from the Asia Pacific?
Yes, we do actually. We speak to a number of people in Singapore specifically, but also in the wider Asia Pacific region. Singapore specifically is really trying to establish itself as a regional and global hub for carbon markets. The government has put in a lot of time and effort to setting this up and welcoming the carbon markets. There's a conference in Singapore in a few just early March, I believe it is, specifically for carbon. So we speak to a number of people in that region, insurance brokers, but also directly with some clients that are active in the carbon space and looking to purchase insurance as well.
Okay, thank you. Another question from Rebecca Rowan. Do your underwriters predominantly have insurance or underwriting background or more from the financial sector? And what is the most interesting or stick in the mud project you have ever come across?
Our underwriters have a mixed background. We have, so my background is in credit and political risk insurance. I did that for a number of years before joining Kita. That's probably one of the most comparable existing insurance markets to our Kita's insurance product at least. So that's a very useful background. We also have people who come from a financial accounting background as well, which is very helpful, specifically when assessing the counterparty risk and the financial health of a project developer. We also have people who come from a very carbon specific background, who've done masters and environmental science and things like that, because that again is the technical analysis of a carbon project is quite key for us. So we have a number of people that come at it from different perspectives. And the most interesting project that I've come across, that's a good one. I think one of the most impressive projects I've seen to date is a mangrove project in Southeast Asia that is often touted as being one of the flagship carbon projects. It is an absolutely massive project that is replanting mangroves along the Indus Delta in Pakistan. That also provides a huge amount of benefit to local communities because there's a revenue sharing scheme and there's various other things that are built into the carbon project that provide a really nice wider set of benefits to the local communities, rather than not simply just removing carbon from the atmosphere. So that's what I think is particularly impressive.
Okay. In interest of time and in view of what has happened in LA recently, I'm going to go to the last question first. What do you see as the impact of the LA fires on the insurance sector, especially with regard to underwriting unpredictable and mounting climate risk?
Yeah, I think specifically for what we do at least, that's always something that we are focused on when we look at any forestry project specifically, but also any other general carbon project is the risk of natural catastrophe, whether it be wildfire or indeed drought or cyclone, hurricane. There is already, as I'm sure many people will be aware of and appreciate, that there's a lot of concern that insurers have around additional natural catastrophe exposure. That will certainly reduce appetite for transactions in specific parts of the world. Mm-hmm. We've seen a number of projects recently in Australia, and so that's an increased risk factor there that we just need to make sure we fully understand and we underwrite correctly when we're looking at projects in locations like that. And what we have seen is the increased risk of natural catastrophe events like that and the climate risk that is causing it, many of these. It will reduce insurer appetite, but it will also increase the premiums quite often if there is to be insurance in those regions. So I think that's probably the obvious quick answer, but I'm sure there's plenty of other knock-on effects that we'll have in years to come.
Okay, thank you. We'll take one or two more questions and we'll end the session. Do you see that carbon insurance will benefit carbon projects that come from emerging markets with their uncertainties?
Yes, we certainly like to think so. We speak to a huge number of project developers themselves who reach out to us to see if we can insure their project specifically, because it will then, it can often help them understand the risks involved in their project when speaking to an insurance company, but equally it can help them gain access to further investment or further buyers of their credits if the insurance is available for that purchase. So we think, and we have seen, and from what we're hearing as well, there's a huge number of benefits that can be offered specifically to the project developers from having insurance involved in that transaction or that structure.
Okay, and one last question. Do you have statistics for project types you have insured? So, for example, ARR, clean cooking, RE, etc.
Yeah, absolutely. We have the vast majority of transactions we have insured to date have actually been ARR, working in the afforestation space. That being said, we have seen we've covered a number of clean cooking and some renewable energy in a small portfolio basis. Clean cooking projects are probably one of the ones we're seeing most frequently at the moment, along with ARR, afforestation. I think those are probably the two main project types that we're seeing at the moment. But there's a spread, and it's always interesting to see which project types become popular at certain times and which one's getting the most funding. But ARR is the biggest one we've seen so far.
Okay. Thank you so much, Alek. It has been a wonderful and comprehensive presentation by yourself, and it's gratifying to see so many questions being posed by the floor, demonstrating the tremendous interest in this subject matter. Thank you all for attending this webinar. Thank you, Kita, for collaborating with us. And I will now bid all of you farewell as we come to the close of this session. Thank you. Have a good day or good morning or good evening, wherever you are. Bye-bye.
Thank you.
Bye-bye.